What comes to your mind when you hear the term yield farming? Perhaps visions of large fields ripe with opportunities, promising bountiful rewards for those daring enough to venture into the world of DeFi. But let's take a closer look. Behind all of these promises and excitement lies a story you might not have heard before. A story where the rewards comes with some serious risks, where you could either hit the jackpot or end up empty-handed in a twinkle of an eye. Now, take a front seat as we unravel the dark side of yield farming, where the rewards are high, but the risks are even higher. Before we start, here's what you can expect in today's video. A clear understanding of yield farming, the risks, rewards, and how it's a cornerstone of earning in DeFi. We'll also highlight the difference between yield farming and staking, explain what liquidity pools are, and why it has higher rewards and risks. Now, without further ado, let's jump right in. Yield farming and staking are some of the best methods to generate passive income in the crypto space. With these two, you can have a steady income without exposing yourself to the risks involved in crypto trading. But are these two methods the same? Well, the terms yield farming and staking have sometimes been used interchangeably, and you might get confused and sometimes invest wrongly. But you don't have to. Stick around until the end of this video for more enlightenment. Now, yield farming, also known as liquidity farming, involves depositing your crypto assets into a liquidity pool in order for them to stay liquid and in return get some rewards in the form of interest. But before we go any further, let's explain what are liquidity pools, because you'll come across this term many times in this video. Now, liquidity pools are collections of digital assets that are locked into smart contracts on decentralized exchanges to allow trading. Liquidity providers or yield farmers lock their digital assets on these smart contracts to create pools for others to use. In other words, they provide liquidity, which is the ability to quickly sell or exchange assets without affecting their price. If that is hard to swallow, then you say it's the ease of converting assets into cash. By depositing assets into a liquidity pool, yield farmers receive liquidity pool (LP) tokens that represent their share. When a trade is carried out, the automated market makers (AMMs) calculate asset swaps within the pool. Note that LP tokens can be redeemed for underlying assets at any time. Having understood what liquidity pools are, let's fast forward to how yield farming works. After depositing your assets in a liquidity pool, the assets are lent out to other investors who are looking for funds to do their own stuff. The money generated from these loans is then distributed to yield farmers, depending on the amounts they invested. It's similar to the way you earn interest from your traditional bank savings account. On the other hand, staking involves locking up your crypto assets in a blockchain network to support transaction verification and network security. To learn more about staking and how it works, make sure you watch our other video about staking here. Now, let's shift our focus and see how yield farming and staking differ to make it clearer. Let's start with their complexity. Yield farming is more complicated than staking because it requires adequate research to identify a liquidity pool with higher profit potential. Besides that, liquidity providers must also decide on a token pair and select a DeFi platform that offers an equilibrium liquidity pool like Uniswap or a customizable liquidity pool like Balancer. On the other hand, staking is much easier because you only need to select a staking pool on a POS network to stake your assets. Your assets are locked up for a given period and you cannot withdraw them until the period is over. Easy, right? But not the case in yield farming, as you will need active management after your assets are staked for you to generate maximum returns. The second difference is the deposit period. Unlike staking, where your crypto assets are locked for a certain period, yield farming provides liquidity to any liquidity pool and token withdrawal at any time. Besides, yield farmers can also move their assets from one liquidity pool to another. Note that the lockup period for staking may range from a few days to weeks or months, depending on the blockchain network traffic. The sad part is that you cannot move or unstake your assets regardless of the market conditions. The other one is on transaction fees. As we have mentioned, yield farmers can move their assets from one pool to another, but that's not without transaction costs. Ethereum network users have to pay more gas fees for faster transactions. Bad deal, because it might eat all your profits, especially if you're a small investor. Staking seems to be a good choice because you don't have to switch pools. Instead, you earn a percentage of network fees when you validate transactions. The next difference is in token requirements. In yield farming, liquidity providers must have a pair of tokens like USDT, USDC to provide liquidity to liquidity pools. For customizable pools, users can provide flexible ratios of these token pairs, but on equilibrium pools, the token supply ratio must be 50-50 with the pair holding equal value. Guess what happens when the value fluctuates? We'll also look at that in this video. Staking, on the other hand, does not require two tokens to provide liquidity, but only one to lock it up in a staking pool. However, some tokens may require you to have a minimum limit. For example, for Ethereum, every validator node must commit a minimum of 32 ETH. The other one is revenue generation. Yield farming offers an APY that varies with each liquidity pool. This typically depends on the market metrics like arbitrage options, available options, and the overall market volatility. Wait a minute, did I just say APY? Well, APY stands for annual percentage yield and works the same way as in traditional finance. It refers to the return of an investment taking into account compound interest. You all know that compound interest grows with your investment. That is, you earn interest on your initial deposits and then earn additional interest on top of that interest, and the cycle continues. Pretty good cycle, right? Yeah, so APY measures the return of such investments over a year. With that said, let's get back to the differences. On the other hand, staking offers a fixed APY that allows users to calculate their future returns. However, its interest rate is much lower than in yield farming, making it suitable for low-risk investors. Note that those who lock their assets for longer periods earn higher APYs than the short-term investors. Then we have the main one that every investor should be aware of before dipping their toes in these investments. You've already guessed it right. The risks involved. It's very important to consider the security of each infrastructure before venturing into any of these crypto investments. Remember what we said in the beginning? Yes, you can lose all your investments within a blink of an eye. Now, each of these strategies has its own drawbacks, but yield farming seems to pose a greater threat. Its protocols can lead to loss of funds, including impermanent loss, especially when the price of these tokens fluctuates when they are still locked in the liquidity pool. Rug pulls is another common risk in new yield farming projects. A crypto rug pull occurs when the project developers manipulate the token value to deceive investors and then disappear with their investments. Normally, these fraudsters attract their investors with a sudden and sharp price gain of the token within a short period. Once the token price hits an all-time high, they sell the token at a profit, leaving their investors with steep losses. Staking, on the other hand, is more secure because users are required to strictly follow its rules in order to take part in the blockchain consensus mechanism. What scares many is that they can lose their staked assets through slashing. This happens if the users try any malicious activities, like manipulating the network to receive more rewards. Having said that, let's look at the dark side of yield farming: more rewards and higher risks. It bears mentioning that yield farming offers or promises potentially higher rewards than all other investment avenues. But let's look at what it offers first before we shift to the dark side. One is that yield farming offers high interest rates. This is because yield farmers provide liquidity to DeFi platforms, which have a higher demand for funds to facilitate borrowing, lending, and trading activities. The second one is that it provides liquidity mining incentives. Many DeFi protocols incentivize yield farmers with additional tokens, known as governance or utility tokens, as rewards for staking their assets. If the project goes on well, these tokens may have the potential for substantial appreciation, adding to the overall returns of yield farming. The other one is that it offers arbitrage opportunities. Yield farmers can capitalize on price movements between various DEXs or liquidity pools. Yield farmers can make more profits when the token prices are skyrocketing. Remember, we said that you can always shift your assets at any time, but don't forget the transaction fees, my friend. However, with higher rewards comes greater risks. One of them is smart contract vulnerabilities. As we've noted, yield farming relies heavily on smart contracts, which are prone to coding bugs, exploits, and security loopholes. Any vulnerability in smart contracts could lead to asset losses or even hacking, as we've seen in various DeFi exploits in the past. Impermanent loss is another risk in yield farming. This happens when the value of the assets in the pool deviates from their original ratio due to price fluctuations. This is common with highly volatile or newly launched crypto tokens. Here's a simplified explanation with an example of impermanent loss. Let's say you deposit an equal value of two different tokens into a liquidity pool. Let's call them token A and token B. Now, the price of token A and token B might change over time due to trading activity. If the price of token A increases relative to token B, traders will buy token A and sell token B. This will cause the balance of the pool to shift. As a liquidity provider, you'll end up with more token B and less token A than you had initially deposited. This difference in value between what you would have had if you just held onto your tokens versus providing liquidity is what's known as impermanent loss. The term impermanent is used because this loss only becomes permanent if you withdraw your liquidity while the prices are still imbalanced. If the prices return to their original ratio, the loss is mitigated. Now, let's get back to the dark side of yield farming. The other risk in yield farming is scams and Ponzi schemes. These fraudulent activities attract innocent investors with promises of high profits, leveraging complex mechanisms and deceptive marketing strategies. They often masquerade as legitimate yield farming projects, exploiting the trust of investors in DeFi platforms. Yield farmers are encouraged to deposit their cryptocurrencies into smart contracts, claiming to offer lucrative yields. However, instead of delivering returns, they either siphon off funds or disappear with all the assets. In addition to that, some dishonest actors may employ multi-level marketing or pyramid schemes. These schemes rely on the constant recruitment of new investors to sustain payouts for existing participants. As we conclude, it's crucial to understand how yield farming works and all the underlying opportunities and risks before diving into yield farms. But what is your opinion on that? Comment down below. I'd be eager to read your opinion. If you are curious to find more, then make sure to click on one of the videos you see on the screen. And with that, we come to the end of this video. If you enjoyed the video, then please like it, subscribe, and don't forget to leave a comment in the comment section.